and welcome to the second episode of By All Accountings. I'm your host, James Pilecchia, and today we will be discussing the debate surrounding the subsequent accounting of goodwill for public companies, and I will later propose a solution to the problem. Let's first read through the FASB's definition of goodwill, which is an asset representing the future economic benefits arising from other assets acquired in a business combination or an acquisition by a not-for-profit entity that are not individually identified or separately recognized. This could be interpreted to mean many different things. I like to think of goodwill as the whole exceeding the sum of the parts, the secret sauce, or the premium paid. From a numerical standpoint, goodwill is simply the excess of the purchase price paid over the fair value of the net identified assets. The topic of goodwill and the accounting for it has been a contentious and much debated topic for over a century. The problem is, nobody seems to agree on how to account for goodwill after it's recorded. Just look at the FASB's recent history. Prior to 2001, you were required to amortize goodwill over a period not to exceed 40 years. In 2001, SFAS 142 said no to amortizing, and instead you must quantitatively evaluate for goodwill impairment at least once a year using the two-step quantitative test. The rationale was that goodwill does not necessarily decline in value over time, and if it does not decline in a systematic manner. While this conceptually made sense, corporations and auditors complained about the time and cost of evaluating goodwill for impairment. Fast forward to 2011, where the FASB allowed companies the option to qualitatively evaluate goodwill first, and if the goodwill passed the qualitative test, then companies can skip the quantitative test. A few years later, the FASB did a 180 and allowed private companies the option to amortize goodwill. And in 2017, the FASB simplified the quantitative test by requiring only one step. This brings us to the summer of 2019, when the FASB released an exposure document that addressed the subsequent accounting for goodwill. As of today, the FASB has not advanced its goodwill project beyond the exposure document stage, but it is considering whether to move back to an amortization model for public companies, and is even considering whether certain identified assets should be subsumed into goodwill. Currently, there are two opposing camps with regard with how goodwill should be handled post-recognition. One group prefers to amortize goodwill. I'll refer to that group as the amortizers. The other group prefers to have goodwill evaluated for impairment at least on an annual basis and conceptually disagrees with the amortization model. I'll refer to that group as the impairers. The amortizers consist of financial statement preparers and their auditors. I do find it interesting that auditors prefer the amortization model, as it would result in less audit fees for them than if they worked with a goodwill impairment model. Perhaps the auditors do find the impairment model too burdensome. Anyway, the amortizers make the following four arguments in favor of goodwill amortization. Complexity. Goodwill impairment analysis is complex. Significant professional judgment needs to be applied when determining the fair value of reporting units, assigning goodwill to them, and reallocating goodwill following acquisitions and dispositions. Let's face it, amortization is much easier. Timeliness/usefulness. Amortizers think that goodwill impairment charges often lag the economic factors that lead to the impairment. This makes sense, since goodwill impairment analysis is an annual and minimum requirement. Amortizers also believe information about the existence of impairment is useful, but not the amount of the impairment. They claim that goodwill impairments are often eliminated through non-GAAP metrics. Commingling. Acquired businesses are often integrated into an acquirer's business shortly after acquisition, or this can gradually happen over a few years. In either scenario, goodwill can lose its separate character and be subsumed into the broader enterprise. This makes valuation more difficult. Cost-benefit. Companies feel that the cost of conducting the impairment test, between the time spent internally as well as the cost of the valuation firms and auditors, exceeds the benefits provided from the impairment analysis. Amortization is much cheaper. The impairers consist mostly of investors, financial analysts, and valuation firms, the latter of which make a living from complex valuations. The impairers take a more conceptual approach to the accounting for goodwill. Their main arguments in favor of impairment are accountability. Business combinations and acquisitions are a key component to the strategies of many businesses. Impairers prefer the impairment model because it holds top-level executives accountable for business combinations or acquisitions that do not turn out well. In other words, if a business combination or acquisition goes south, the impairment charge should soon follow. Use of the amortization model will let the executives off the hook, as it would obscure the existence of an impairment. Materiality. Intangible assets, including goodwill, represent an increasing proportion of the acquisition price in a business combination. Because of this, impairers think that the complex analysis is worth performing. Decision-making information. Goodwill impairment is a good predictor of negative future performance, which is valuable information for investors. Does not inherently lose value. Impairers contend that goodwill does not lose its value systematically over time as in an amortization model. In fact, it's possible that goodwill can increase in value over time. So what does academia have to say about goodwill accounting? It shouldn't surprise you that they have not reached a consensus. I'm not going to bore you with a plethora of study results, but I'm going to share with you the following two, which I found interesting. In a study published in 2011, Cheo Lee found that goodwill impairment charges under SFAS 142 are significantly associated with future year-end cash flows, and that the higher the impairment charge in year one, the lower the cash flows in years 2 and 3. Conversely, Lee noted that goodwill-related charges, mainly amortization expense, were not significantly related to future cash flows. This relationship was also found by Henry Jarva in a study published in 2009. Overall, the majority of studies indicate that goodwill impairment announcements have a negative relationship with future operating performance. In a study published in 2017, Kevin Lee and Richard Sloan found that SFAS 142 resulted in inflated goodwill balances and untimely impairments. The results of their study also suggested that some managers have delayed goodwill impairments to temporarily inflate earnings and stock prices. Before I weigh in with my proposed solution to the goodwill accounting dilemma, I think it's important that we look at some key statistics to gain a sense of perspective. According to a 2021 article by the Pennsylvania Institute of Certified Public Accountants, there's close to $6 trillion of goodwill on global balance sheets. According to the 2017 Purchase Price Allocation Study by Houlihan Lokey, the amount of purchase price consideration allocated to goodwill has increased from a median allocation of 36% in 2016 to 40% in 2017. Let us look at a couple of charts. The first one shows goodwill as a percentage of total assets by industry. Whether you look at the mean of 20% or the median of 18.3%, goodwill is a material portion of the balance sheet. The second chart shows a trend of total goodwill impairment charges and the number of impairment events from 2014 to 2018. As you can see, the impairment charges range from between $25.7 billion and $78.9 billion, while the number of impairment events did not move much year to year. Regardless, the impairment charges were significant. So what do I think should be done with the subsequent accounting for goodwill? As a former auditor for 8.5 years, I can definitely appreciate the hardships encountered by preparers and their auditors. However, I strongly lean toward the financial analyst and investor side, as the 10K and 10Q was created with them in mind, not the company or the auditor. What I'm going to propose is something far more radical than an impairment-based model. What I'm going to propose is that goodwill be subject to fair value accounting on a recurring basis. Yes, quarterly, with the gain or loss flowing through operating income. I can only guess what's running through your minds at this moment. James, what in the world are you thinking? Have you completely lost your mind? What you are proposing is going to create even more undue burden on companies and auditors. Well, before you fill my inbox with hate mail and you petition the New York State Board of Accountancy to revoke my CPA license, I'm going to present my 4 counterpoints to the arguments of the amortizers. Complexity. This is true, as goodwill impairment testing can be subjective and requires an expert skill set. However, complexity is not something the accounting profession should run away from, especially not with the dollars that are at stake here. Instead, we need to embrace the complexity and become better at valuing and auditing goodwill. Timeliness/usefulness. With fair value measurement at the end of each reporting period, the timeliness issue is mitigated. I also think the quarterly frequency of fair value measurement will lead to more relevant and useful information for investors and analysts. Regarding the carve-out of goodwill impairment and non-GAAP metrics, I imagine this will still happen with the fair value model, but I do not hold much weight in non-GAAP metrics, as I have seen during my days as an auditor how they can distort economic reality. Commingling. I mentioned earlier that through the integration of acquired businesses, goodwill can lose its separate character and be subsumed into the broader enterprise. However, goodwill and related assets of acquired businesses are very trackable in modern ERP systems via separate entities, sub-accounts, etc. This should not be an issue if proper planning is performed. Cost benefit. It is true that an impairment model for goodwill is costly and will be even more so if we apply a fair value model. However, I think it is even more costly to deny investors useful information about a company's performance, as this could lead to a less efficient allocation of capital. I think of the studies I mentioned earlier by Lee and Jarva that linked goodwill impairment with future operating performance. I also think that companies, valuation firms, and their auditors will become more efficient in this process by necessity as they will perform the valuation on a quarterly basis. This could help keep costs in check to a degree. Now, I know some companies are going to balk at this and they don't want to apply a fair value model. I say to them, they always have the option of going private and applying an amortization model. I even hear Elon Musk may be interested in taking them private. In all seriousness, I'm not anti-corporate, far from it. In fact, if we apply the fair value-based model to goodwill, it will result in a fairer outcome to corporations than an impairment-based or amortization-based model, as it could potentially result in a positive P&L impact. So if the acquisition or business combination pans out, then the top-level executive can get a well-deserved pat on the back. Well, that wraps up today's discussion. I thank you for watching, and I will see you soon for another episode of By All Accountings.